So if you've got 25 years or more before you need to think about drawing on your investments, then you don't really need to worry about bond versus equity diversification. However, if like me, you're probably going to retire in the next 5 years, it's absolutely critical. So the green line is how my investments have performed over the last 30 days. My actual target for each month is 0.5%. So at 0.61%, I'm pretty happy this month. The grey line is the performance of VWRP, which is the FTSE All World. So we know that the FTSE All World is a very diversified stock with over 4,000 individual equities in it and also split globally as well. But when equity markets do take a dip, then obviously the All World will follow. Bonds, however, don't tend to follow equity markets. And although returns are much lower with bonds, they do weather the storm better when equity markets take a downturn. So here's the actual split on my portfolio, with 67% in bonds and 27% in stock. I keep 5% in cash because I do tend to move 4% of my bonds into equities on a Monday morning. This is because 67% in bonds is a little high for my risk appetite, and I'm gradually moving from bonds into equities. But I don't want to do that all in one go. I prefer to do that incrementally each week. I'll probably settle on 40% bonds and 6% equities. So if you've heard my outro, then thanks for listening. And if you haven't, then here's probably the most important bit of investing advice you'll hear on YouTube. Don't buy or sell shares in a company based on what someone on YouTube tells you. The big Wall Street analysts have large teams of professionals with access to vast amounts of data on every single listed firm. There are no YouTube gurus who know better than them. Use YouTube to find interesting bits of information on companies that you may otherwise miss. And when you find something interesting, do your own digging and see what the analysts in the big firms are saying. Never invest more than you can afford to lose, and don't expect to get rich quick. If you are interested in my background, I come from 16 years in risk management with PwC and Deloitte. I've never been on a trading floor in my life, but if I had, it wouldn't give me the edge on the big firms because they have big teams and masses of information. So don't look for a guru with an edge. Look for information on companies you're interested in. And if you're looking to invest a large amount of money, don't put it on individual stocks. Choose an index fund. The All World Index is a representation of all the stocks in the world. And if one company goes broke, then the index won't even move. Whereas if you've only invested in that one company, then you may have just lost your pension. Keep it fun, keep it affordable, and subscribe to keep getting my updates. Thanks.